Hi, Michael Yardney, and welcome to this week's masterclass. What I'd like to spend some time doing is explaining what's really happening in the property markets. The intention of this is to help make you a more informed investor by giving you some facts from CoreLogic and the ANZ Bank, rather than all the confused messages the media is currently giving us. So bottom line is we're not having a crash, we're having a controlled, soft landing. But at the end of today's session, you're going to have a better understanding of what's happening around Australia, as well as some forecasts from the ANZ Bank about what's likely to happen moving forward in our property markets state by state. I'm about to spend half an hour with you, so do yourself a favour and turn off the mobile phones, turn off the emails, concentrate on this, because if you're interested in property, if you've already got a portfolio, if you're interested in getting in the market, why not understand exactly where we're heading at the moment? So I'm going to start the graphs now, and let's see if I can help you understand what's happening in our property markets today. Look, there's no doubt that our housing markets are weaker, and we were expecting this stage of the property market to slow down a bit. We've had some great times over the last couple of years. The Melbourne and Sydney property markets have increased considerably. Other states have done very well as well, until last year when the cycle turned. I'm about to show you some numbers and figures to explain exactly what went on, but I just want to remind you that every boom leads to the next downturn, just as each downturn leads to the next upturn. And in the last decade, we've had two other downturns. This is the third one. People tend to forget that. In 2010 to 12, rising interest rates stopped our property markets and property values dropped a little bit. And much the same happened in 2009 after the global financial crisis. So I'm going to show you some numbers and figures to show you that this time round, it's actually not as bad as last time. We're in for a soft landing, and there are great counter-cycle opportunities if you're ready to get into the property market at the moment. Having said that, as this market slowdown was necessary, we could have ended up with a property bubble followed by a crash that some property pessimists were predicting. I remember when we had the last downturns, people told us it was the end of the market as we knew it. The property values weren't going to increase anymore. But just look what's happened since. Since then, overall, a lot of Sydney property values have doubled. Some haven't gone up as much. Some have only gone up 50%. Melbourne property values in general increased 50% since that 2012 downturn. Why wouldn't the prices come off a bit now as well? But before I give you more details, and I'm going to show you some interesting graphs coming up, let me reassure you that our property markets are underpinned by strong population growth, a sound economy, a banking system that now more than ever is going to be stable following the Royal Commission. So in my opinion, it's just another winter. Every property boom sets the scene for the next downturn. Every winter for 6,500 years, or as long as they've been measuring winters, has been followed by spring. And I'm prepared to put my money on spring's going to follow this winter as well. In fact, I have put my money on it because only last week went to the bank to get a loan for another property. So I see it as being a time of cautious optimism. Now, I'm not sure where you are in your investment journey, so we can talk a bit about what the next stage is and what you could do at the end. Let's just have a talk about what's currently happening in the market, because we've got to be careful. You can't just buy any property. You can't use some of the rules you used before, because in this slower property market, you're going to find that the market's not going to cover up your mistakes. It's not going to be very forgiving. So let's see what the latest figures from CoreLogic showed. And these came out just a short while ago, showing that overall, the Australian property markets have dropped less than 3%, 2.7% over the last 12 months. Now, the markets are very fragmented, and they're mainly driven by the big markets of Melbourne and Sydney. And yes, Sydney property values have dropped for about a year now, and they're down about 6.1%. I'm going to go state by state and explain to you a bit about what's going on in a short while, so hang around because I'll go through each state's markets. Melbourne's dropped about 3.4%. Half the markets have dropped in value, others are going up, and so on balance, we only had 2.7% fall in property values. But if we actually have a look, you can see that the regional markets are now catching their breath as well. Regional markets outperformed the capital cities for a short while, but now they're having some challenges as well, and that doesn't surprise me. So this is a graphical version of the chart you just saw a moment ago. What's happened to property values? Hobart's been the best performing property market, you can see that, and so has the rest of Tasmania. But that's very likely to change. So I'll later on go through state by state, explain to you what's likely to be ahead, and you'll see that there's going to be some challenging times for the Apple Isle moving forward. So I'd be steering clear of that market. This graph shows how far values have fallen since their respective peaks. And you can see the biggest fall has been Western Australia, where the mining towns were, and Perth has also dropped, as has Hobart, the mining towns. Why won't Melbourne and Sydney drop to that extent? Some people are wondering, and the answer is the reason those mining towns dropped so much in value is because their economies dropped. People stopped moving into those locations. In fact, they moved out of them to the states where the economy and the construction boom was growing. The Melbourne and Sydney property markets that are falling a bit at the moment, that are having a soft landing at the moment, are underpinned by strong population growth, by a strong economy, by a shortage of houses in many locations, not in all locations. And as I said a few times, we'll go through it state by state in a moment. And we know the reason this has occurred is because of decreased housing credit. You've heard me say it before, residential real estate's a game of finance with some houses thrown in the middle. How much finance you can get, whether you're a home buyer or an investor, is going to make a difference to what you can buy, how confident you are buying, and pushing up the property values. So you can see that in 2014, things started to go down a bit. Investors in particular and owner-occupiers started having difficulty getting loans because of APRA. APRA slowed this credit, caused this credit squeeze by slowing down lending criteria, putting different restrictions on banks. Now, that wasn't bad. They've actually slowed this booming market down. The booms were in Melbourne and Sydney in particular, and then later Hobart, but they've slowed them down in a low interest rate environment, and that's actually very good because it means fewer mortgage defaults and a much healthier environment to work in. So it's really been the credit squeeze that has stopped this property boom as well. Now, this is an interesting graph showing how Melbourne prices are predictable if you look at auction results. So what the ANZ Bank here has done, so those previous graphs were from CoreLogic, but most of the graphs now are going to come from ANZ Bank. And what they've shown is Melbourne house prices in the brown orangey sort of colour, and the blue line on the graph that you can see here is actually auction clearance rates but moved forward 3 months. So what they're saying is auction clearance rates are a predictor of what's going to happen to house prices further down the track. Now, if you look at the left side of these graphs, in 2012, the downturn I mentioned we had a while ago, 2009, the downturn we mentioned a while ago, auction clearance rates dropped lower than they are at the moment, and house prices dropped as well. But again, after each winter, spring came and then summer came, and look at the great run we've had since 2012. So it's time for us to catch our breaths again, and for some property values to fall a little bit as they have at the moment. So let's go through some of the property markets and explain what's happening. So this is a graph showing what's happened in the Sydney property markets. We know Sydney is our most expensive city. It's our most valuable city in many ways too. And the Sydney property market peaked, as you can see in this graph here, in the middle of 2017, and it is experiencing a soft landing after 5 years of growth. You can see the previous slowdown, the previous bottom was in 2012. You can see how prices in Sydney dropped in 2009. You can see how they dropped in 2012 as well. But really what's happening at the moment is that the prices in Sydney are slowing down, not everywhere. In fact, we're quite active in the Sydney market and found that good houses and investment grade properties are still holding their own because there's a lack of supply and there's still people out there wanting to do it. It's a similar story in Melbourne, where the property values are dropping a bit as well. But what's underpinning Sydney's property values are strong economic growth, jobs creation, and the strong population growth. It's at the same time, international tourists are interested in Sydney, migrants are, investors are continuing on there. However, now more than ever, critical property selection is going to be more important to find an investment grade property. You just can't buy any property and hope that the property market's going to cover your mistakes. So the Sydney property market is definitely having a soft landing and is likely to continue on to do so for another year or so, but we're probably more than halfway through. So don't wait to hear that the property market has picked up. It's a good time to be very, very selective and find the right property, which you're going to look back at in a few years' time and say, hey, I've actually got a foothold in the Sydney property market at a price I couldn't do again today. The next graph is actually showing Queensland. Now, Queensland actually is a very, very big state, and really, while it's labelled Queensland, they're showing the figures for the Brisbane property market. And to be fair, the Brisbane property market has had very subdued growth over this last cycle. You can see there that there's been periods when it's actually grown better than others, but it's been slow growth compared to the big two capital cities. Looking at the far left side of the graph, you can see how well the market did before the global financial crisis. Anyway, now is Brisbane's turn in the sun. It's relatively affordable, but what's going to push up Brisbane property prices this cycle is not just that it's affordable, but that jobs are being created there. There's big infrastructure expenditure there. The government is spending money. Interstate migrants are moving there. Queensland's led the nation in net interstate migration over the last years. The population has increased by 81,500 people over the last 12 months. So therefore it's been a large part of Australia's population growth. And this is because they're now moving there, not because it's a lovely place to live, it always has been, not because it's cheap, because it has been for a long time, but because there are good jobs there. Unemployment is still on the higher side. That's still got to come down a bit. But I'm talking about Brisbane. Queensland is a very big market, and in other parts of Queensland, other than Brisbane, in the Sunshine Coast, the Gold Coast, far north Queensland, a lot of the employment is part-time and casual. And so they're not the sort of people who can afford houses, and banks won't lend money to them. So avoid regional Queensland and even the big other areas like Townsville and Mackay and the Gold Coast and the Sunshine Coast. They're too cyclical. They're too volatile. What about Victoria? Well, Victoria houses Melbourne. Melbourne market is the most livable city in the world. Well, actually this year we lost that mantle with a number 2 most livable city in the world. And the Melbourne market's been performing very nicely, but peaked in November last year and is experiencing a soft landing after 5 years of strong growth. Values are down a bit from their peak, as I said, but that's not unusual considering the high growth that we've had for a long time. Melbourne's property prices, let's be honest, are likely to fall a little bit further, but they are underpinned by a robust economy, strong jobs growth, and Australia's strongest population growth. We're getting 35% of all overseas migrants coming to Melbourne. Melbourne ranks as one of the 10 fastest growing capital cities in the developed world, and its population is likely to increase by about 10% in the next 4 years. Where are all those people going to live? And that's what's underpinning Melbourne's property values. And there isn't the big oversupply of new apartments, other than in the CBD and in Docklands, that there is in the rest of Australia. So Melbourne's poised for a soft landing, and currently we're being very careful of what we're buying in Melbourne. We're basically buying townhouses, houses, and villa units, which have got a great land component for clients rather than apartments, because apartments for the next little while are probably going to suffer a little bit. Western Australia, well, the Western Australian property market has really suffered for around 4 years, and you can see that after the end of the mining boom. Unfortunately, it's got some suffering to go. Now, in a while, I'm going to show you some forecasts from the ANZ Bank of what's going to happen, and the suggestion is that even though it may plateau off in a little while, Western Australia is a long way before its prices are going to go up. Because at the moment, people haven't been putting their homes on the market in Western Australia. They're not prepared to put their homes on the market yet in this falling market. So when prices eventually plateau, more properties are going to come on the market, buyers are going to move in, more properties are going to come in. And so therefore, supply and demand ratio is going to mean that values won't go up for a while. And then eventually, probably in 2021, 2022, values are going to start to rise. Not the right time, much too early yet for a counter-cyclical play in Western Australia. Now, I haven't got graphs for you today for the other states, so let me quickly run through them. I will give you some from forecasts with some graphs from the ANZ Bank in just a moment. But Hobart's been a very strong performing property market, but it's one of those markets that has had 5,000 transactions in all of last year. It's 1% of Australia's property market. It doesn't take much to swing it one way or another. And currently, investors who were chasing the next hotspot are now looking for the next one. Of course, that's not the right way to do things, but people are doing that at the moment. So avoid Hobart and the rest of Tasmania. It has been very, very strong. Some people have got short-term capital growth. I don't look for what's working now. I want to invest in what's always worked, so one has to be careful. So Hobart I'd be avoiding. Adelaide's doing nicely. It's just growing tinily a little bit, but it hasn't dropped in value, but it's not got the strong wealth-creating rates of capital growth that you require. So lovely place to live, but I wouldn't be investing in Hobart. Darwin is still suffering from the end of the mining boom and will for a long time. Don't even look there if you're thinking of investing. Canberra's doing okay, except I'm expecting some interesting times in politics over the next year, before the election, after the election as well. And that often the uncertainty of that affects the Canberra property market. But Canberra's the quiet achiever that keeps doing very nicely. So this is an interesting graph that a lot of research houses are looking for new ways of understanding what's happening to our property markets. And ANZ Bank have got now a housing search index looking at searches on Google for things like mortgage rates, auction clearance rates, housing, properties for sale, property investment. And what they've done is they've graphed here two things. Their new search engine going back, way back for over 10 years, and also house prices. And what this is they've actually seen that search trends, they've moved it 3 months forward, are a good indication of, as a leading indicator. So a leading indicator is what's happening now that's going to create property value going up or down in the future. What I've showed you up to now, those figures and statistics are lagging indicators of what's happened in the past. But a leading indicator, another one is actually finance approvals. For example, if you're going to get a finance approval, you're planning to buy property in the future. So this particular chart is suggesting that if you see the little uptick at the bottom there, that there's more people interested in property now, which is an interesting indication that down the track, it's very likely that the market is about to turn. Still too early to tell yet, but interestingly, we're getting much the same response on my property update blog. It's gone up in readership 27% in the last 3 months. We are getting regularly 15,000 people a day looking at property updates, significantly more than at the beginning of the year, significantly more, as I said, 3 months ago. So it's interesting that people are inquiring, and interestingly, more people are inquiring to Metropole to see about our services to help them through the interesting times at the moment. So there are some indications that the market is turning. Okay, here are some forecasts from the ANZ Bank looking forward. And what these forecasts are suggesting is on the left-hand side there, you can see Australia and then state by state, 2016, 17, which are historical facts, 2018 forecasts, even though we're almost through the year, and then 2019 and 2020. Now, I'm going to get rid of my face there so that you can see all that. And what they're suggesting is, we'll look at Hobart, for example. It's had the best run, but it's going to peter out over the next year or two, which is what I was suggesting. Going back to the left side of the graph, Sydney's had its worst time in 2018, going to have less fall next year, be more or less stable in 2020. Now, having said that, there's not one Sydney property market. There's multiple markets affected by geography, by price point, by type of property, and some areas are still doing well. Same with Melbourne, it's actually going to do better. Brisbane's actually had minimal growth, but interestingly, just looking at the results of some of the clients that we purchased for in Brisbane over the last 3-4 years, there's been multiple suburbs with double-digit capital growth in Brisbane, while overall capital growth has been 1, 2, 3%. And so, again, using my top-down approach, selecting the right properties in those investment-grade locations has made a big difference in Brisbane, and many of our clients have done very, very well there. Adelaide's market's going to taper off a bit. Perth's going to stabilise eventually by 2020, and as I said, property values won't start picking up till long after that. Hobart's going to have a rough time. Forget Darwin, and Canberra's just going to continue to be Canberra, which is actually very nice. One of the big challenges, though, with the property market is first home buyers, and there's a lot of fuss made about that. And this is the deposit affordability gap. So it's actually not servicing the mortgage, but getting a deposit that has been an issue for a lot of first home buyers, allowing them to get into the property market, but many are using the bank of mum and dad to get there. But currently lower prices are helping the deposit affordability a little bit. So here you can see how first home buyer finance commitments fluctuate. So after the global financial crisis, you can see that first home owner boost that pushed up first home owners to almost double what they were as a percentage of the market a couple of years beforehand. And it happened again in 2012. And it's happening again now. Can you see what the governments do? They're not going to want our housing markets to crash. So when there is a sign of the market turning down, they will give first homeowner grants. They will give other incentives. Banks are going to change your 25-year mortgages to 30-year mortgages. The system is underpinned the property markets are underpinned by a government and a banking system that doesn't want the property markets to fail. So here you can see how stamp duty discounts are providing some relief for first home buyers in New South Wales and Victoria. These new first new home buyers are actually entering the market once again. Now, vacancy rates. Normally what happens when property markets go up a lot during the boom phase of the cycle, property values and rents, property values goes up, rents don't go up as much. And now at this stage of the cycle, normally rents start to increase. They haven't yet. And that's a lot to do with vacancy rates. Now, you can actually see here that the Perth property market, the vacancy rate's still high. Melbourne and Sydney property markets, the vacancy rate's hovering between 2 and 3%. You probably have heard the fact that 3% is a balanced market. It's not, because if these factors, if these levels are less than 2 and 3% of what's happening to vacancy rates, it should mean that there's too few properties for the number of people looking and rents should go up. Our research at Metropole shows that it's actually 2% is a neutral market, and vacancy rates below 2% push up property values. Now, interestingly, rents are not going up much. I said property values, but property rents, because vacancy rates are still a little bit high because there's been a lot of overconstruction. Having said that, at Metropole in Melbourne, Sydney and Brisbane, interestingly, vacancy rates are very low. I know in Melbourne and Sydney, our vacancy rates are somewhere between 0.5% and 0.7%. In other words, significantly below industry averages. And that's how our property management division helps our clients. We're currently looking after close to $2 billion worth of properties for clients, and we'd love to help look after your property portfolio as well, because, or just even you've got one property, because we've managed to keep our vacancy rates low and our rents and returns to our landlords very high through some great systems we've put in place. What this is showing is that rents haven't grown much. This is rental growth going back for 20 years though, or 30 years I should say. But having said that, Perth rentals are dropping. Melbourne and Sydney property rentals are growing slowly, but the turn will come as we slowly catch up and use up, soak up the excess stock. Now, regularly CoreLogic produce a pain and gain report, and they brought one out again recently showing who sells at a loss and who doesn't sell at a loss. And clearly, the longer you own a property, the less likely you are to sell at a loss, and houses are less likely to sell at a loss than units or apartments, as this graph shows. But let's actually have a look at this in a little bit more detail. Property values selling at a loss have jumped just a little bit at the moment, even though the total losses remain well below previous peaks in Sydney, Melbourne, Brisbane, Adelaide and Hobart. So most people who've bought, unless they're selling right away, are not, I should say, sell at a loss, which is good. Now, this is another graph showing you about housing finance, and I've explained how finance really controls our property markets. It's really related to the availability of finance for homeowners and investors. As you can see, in 2014, APRA started increasing, tightening the screws, increasing the restrictions on banks, and there's then been higher requirements to prove serviceability. You've actually had to be able to service loans at higher interest rates. There's had to be more accountability of what all your expenses are. And you can see how during that time, investors are the ones who've suffered the brunt of it, while homeowner, well, they've actually kept going. As you can see, their homeowner loans are continuing on. Credit growth is still positive. So we are still lending more money than we did a year ago, but not a lot more money. And as you can see, investor lending has trickled down a lot. Interestingly, though, what this graph is showing is that the overall rate of growth of loans is increased. So the average owner-occupier loan has increased and the average first home buyer loan has increased. What's likely to happen moving forward? The APRA commissioners have actually said that they've done the bulk of the work. So they believe that they've now slowed down the boom. So the suggestion is that APRA is not going to tighten the screws anymore. I can't see any reason why the Reserve Bank is going to raise interest rates. They're not going to do it until we've actually got inflation picking up, wages going up, house prices going up. There's no reason for them to raise interest rates. And if they did, there'd be more people in financial distress. But at the moment, these graphs are showing that's not the case. So APRA's not going to tighten the screws anymore. The Reserve Bank is unlikely to raise interest rates for another couple of years. And while the banks may raise interest rates slightly as out of cycle rates, the last one that all the fuss was made about was a 0.14% rise in interest rates. Not a 1.4%, 0.14%. And the media had a frenzy. That's not going to affect people. So what this graph is showing is that the share of households in financial distress is actually very low. Now, they often show this sort of graph that what's happening is in Australia, household debt to income ratios has gone high. But recently, the Assistant Reserve Bank Governor said that debt in Australia is in general in the hands of people who can afford it, people who own homes and are borrowing against their homes to buy investment properties as well. So the majority of the debt is in the hands of the wealthiest people. Now, there's no doubt that some people are going to get themselves in trouble. There's no doubt that some people are going to overcommit themselves and borrow more than they should or go off and get credit card debt. But in general, the debt is in the right hands. And this graph shows how many households have a mortgage buffer. They're paying in advance. Interestingly, what's happened is as interest rates have gone down, many households have kept up the same repayments. And you can see there's a large percentage, 24%, who are, over 30% that are more than 2 years in advance of their payments. So they're actually doing okay. So a lot of people are paying more interest than repayments than they need to. And yes, there will be a group of people who are going to swap over from principal and interest to interest-only payments. But in general, the numbers of people who are going to have issues with loan delinquencies, bad debts, is on the very, very low side. So there always will be some, and this will be some people who've overextended. You can't legislate against people overcommitting themselves. and people buying in the wrong locations. Some will be investors who bought off the plan and already started off with negative equity. Some will be people who bought in regional towns and mining towns. But in general, the levels of home delinquency is actually very, very low. So what that means is that we're actually at a point where the market is catching its breath, slowing down a bit. We're having the winter of the property market to be followed by the spring. And in winter, what your job is to get yourself set for the next cycle. Now, I don't know your personal circumstances. You may be in the position to do something, you may not. But this is the time to plan and strategize. What do I mean by that? Owning an investment property is not a plan. Just holding an investment property and not reviewing its portfolio performance is not a strategy. So we'd love to sit down with you at Metropole and help formulate a strategic property plan. When you do that, what's going to happen is you're going to sit with one of our strategists. They're going to see where you are and where you want to be, and they're going to take into account your income, your risk profile, your time frames, and lay out with lots of charts and graphs. They've got to go home and do some research to do all this, a plan for you. Our strategic property plan has a whole lot of what ifs. Some people are going to cut back from 2 incomes to 1 because they're having a baby. Some people are going to increase their income. Some people are going to want to buy a house and wonder, should they buy a house or should they buy an investment first? And some people are sitting on underperforming properties, but they're not sure what they should do, if they should get out or not. The example I often give them is you should treat your property investments like a business. So if your property isn't performing, it's a bit like if you had a business and you had employees and they'd come to work late and they'd play on Twitter and Facebook all day and they'd go to lunch and come back late and not see the customers and the clients. You'd do a performance review. And sometimes you'd actually have to let them go. And sometimes you'd have to pay a redundancy package to let them go to get a better employee who's going to earn you more money. Much the same with your properties. If you can only afford to own 3 or 4 properties or 1 or 2 properties, you've got to own the best ones, the best performing ones. Some people say to me, oh, Michael, it's not costing me any money. Yes, it is. There's the vast opportunity cost because I've seen so many people who've missed this magnificent boom, the best boom in the last decade or 2 decades in Melbourne and Sydney because they've sat on underperforming properties. So I guess my suggestion is you come into the team at Metropole, have a strategic portfolio review where we can see how your property is performing, see what your opportunities are, because part of that is a finance plan, a finance assessment through a strategic finance broker, and then map out a couple of what ifs, a couple of scenarios with some assumptions so that we can see, are you on track? Maybe you're not going to be on track to get where you want to go, because at the beginning, the successful paths and the non-successful paths look much the same. So it's important to spreadsheet them out and see what's going on in the future. If you're interested in this, go to metropole.com.au, find out all about it, click on the tab under Advisory and Strategic Portfolio Plan, or just give us an inquiry or ring us at 1300 Metropole, because we'd love to sit down with you and plan. This is the time to plan. For some of you, you won't be able to do anything. For some of our clients, we'll just give them a book, or prospective clients and say, here, read Michael's book. For others, we have to sit down and do the strategic plan. And the end result is you're going to have some options. See, planning is bringing the future forward and doing something about it now so you can move ahead knowing with a strategy and some guidelines. And then we hold your hand once a year to make sure that it's all continuing along as you expect it. So there you have it. We're in some interesting times, but a good time to sit back and take advantage of the opportunities to buy an investment grade property at a great price, countercyclically, if you're in the position. And if not, get yourself set with the right structures, the right finance to move forward when the time is right for you. Thank you so much for spending this time with me. I hope you got a better insight into what's happening in the property markets, and I look forward to being part of your wealth creation journey.